All right, I'm going to finish up Chapter 8 today, just this slide actually. Just have one last point to make regarding allowances. Remember, in the past 2 weeks we have been talking about accounts receivables in case that customers have delayed payment or they don't have enough fund on hand. How do we account for those cases and how do we journalize those transactions? Okay, so this last slide here shows on balance sheet how we'll be able to report all these allowances. And keep in mind that allowance account is a contra asset account. So just like accumulated depreciation also always is listed underneath planned assets. Allowance for accounts receivables, allowance for uncollectible accounts always is listed as a deduction account for accounts receivables. Okay, so meaning that this line here shows the net of accounts receivables, the net realizable value. That means that $400 is the estimation of uncollectibles in total for 2014. $300 is, $400 is for 2015, $300 is the total uncollectibles for 2014. So the net of those we estimate and we think the possible collectibles that we can actually get on time is $2,400. Okay, that readily subtracted the $400 and $500 from receivables account. So there's two ways to represent these. You can either represent it as a net form already, or just put it in separate lines. So you have the original balance of accounts receivables. This relates to the total sales or service revenue. And then you have allowance account for uncollectibles listed right underneath it. But both of them represent the same information. Okay, the key point here is to get to this. The net realizable value of accounts receivables basically is the part that we think highly likely will be collecting on time. We estimate a pool of allowances based on, remember, percent of sales for how old the accounts receivables are, aging accounts, remember that table? Both of these we're trying to estimate a pool of uncollectibles based on prior year's experience. So we want to represent that even though we have $2,800 of receivables on the financial statements, it's likely that $400 we may not be able to collect it on time. Okay, that's the whole purpose of this chapter, introducing the allowance method. How do we estimate uncollectibles? The second part is that you need to know notes receivables, the different cases. Remember, how do we create the notes? How do we calculate interest on notes? How do we recognize that we have received the notes receivables and also interest? So the maturity value. So these are the key points for this chapter. Okay, now some of the sections that I didn't cover in Chapter 8, don't worry about them. Credit sales, ratios, you can drop them for midterm. Okay, anything that I did not cover in class, you don't have to review for midterms. All right, so a lot of materials, I'm just going to focus on the key points in each and every chapter. Okay, so Section 4 and the last section, Section 6, other than this balance sheet part, all the ratios, you can just skip it for now. Okay, if we have time, we'll come back to it at the end of semester. Okay, so we're going to move on to Chapter 9, Plan Assets. Okay, 8 and 9 we're both covering assets-related topics. Accounts receivables is related to current assets. Remember, it's being collected on a daily basis. A part of it may not be collected. How do we account for those? Chapter 9, we're going into long-term asset. Okay, plan asset is another way to say long-term asset. And this section, this entire chapter will be going over how to account for, how to measure the cost of plan assets, how to account for depreciation. We talked about this a little bit in the first 4 chapters. Remember, we divided by the useful lifetime and depreciate assets along the years. So that, in the first 4 chapters, we didn't mention the official name for that depreciation. That's actually called straight line depreciation. Okay, in this chapter, we'll be going over other methods to depreciate different types of plan assets. So in the second section, you'll be introduced to units of production, depreciation method, double declining depreciation. But the core of all of them is to measure how we have been using plan assets in company. So we want to estimate, we also want to measure and recognize that we have been using long-term assets. And even though we're not slicing it into pieces, it's not really growing old by looking at it, but we have been using it, so it's a type of expense, depreciation expense that we want to measure. Okay, now the third section here goes into disposal assets, selling, trading long-term asset. So after the major useful lifetime, useful years of the asset, oftentimes companies will want to purchase new assets to replace the old one. So what would happen for those cases? How do we estimate whether we have gains or losses when we replace these assets? So it could be simply throwing it away or trading it for similar type of asset. So there are several transactions under the third section that you also need to know. Okay, so the heavy part of this chapter really is the first three sections. Okay, you need to know how to measure different types of assets, the cost of the asset. You need to know different types of depreciation. How do you calculate them? Okay, there's three different types. Disposal, selling assets, there's 5 different situations. So the first 3 sections is really the heavy part of Chapter 9. And today I'll try to go over the first 2 sections. And then third section, fourth and the fifth section I'll briefly touch on next Monday. Okay, so the general characteristics of plan asset is that it has a lifetime longer than a year. Remember, short-term and long-term, the definition, the threshold basically is if anything has a lifetime less than a year, is short-term asset. Longer than a year is long-term asset. Relatively speaking, compared to inventory individual units, long-term asset, each and every unit, meaning each and every machinery, equipment, is relatively more expensive. Okay, now a key point here, the first bullet point, is that remember, you have to keep in mind that plan asset, we're not purchasing it for the purpose of reselling to other customers. Okay, it's not like inventory that you purchase in and then you mark up a price, you resell to customer to gain gross profit. Okay, plan asset, the purpose really is to support either offices or warehouses. So for example, you may have forklift machines, you may have different equipment to help move around inventory in the warehouse or within businesses. You have vehicles to help you ship the items to customers. Okay, these are the things we call plan assets. So they're not there to resell to other customers to gain profit, but they're there to support daily business operations. So other things could be simply just furniture, desks, chairs, anything you can physically see by your eyes in the office, in the warehouse. Long term, that can be used for more than a year is considered plan asset. Okay, so it lasts for several years, and later on, after its main useful years has been, after the main years that has been used up, when we use the assets in the business, we may want to sell it or trade it with other assets. Okay, so just keep in mind that it's not there to resell to other customers. It's there to support either the production cycle, the sales cycle, or administrative offices. Now when we sell and trade assets, so we'll talk about this on next Monday, you may be able to identify gains and losses of asset. Meaning that when you sell something, definitely you're getting cash or other type of reward from others. We want to compare the cash amount with the current asset's value and see if there's gains and losses with that selling or trading transaction. So if you still recall in Chapter 5, we talked about a different type of income statement. Remember, multi-step income statement? So we would start from sales, just like a regular income statement, and then we subtract cost of goods sold. So then what do we reach after that?
Inventory.
Close. Not close enough. Sales minus cost of goods sold gives you a first subtotal called gross profit, right? And then once you have gross profit, then you have all the other operating expenses. Remember, there's selling expenses, general expenses. After that, you get operating income. And I mentioned that operating income could be different from net income in the case there's gains and losses or interest expense or interest revenue. So remember in multi-step income statement, the very last section, other revenue, other expenses, this is one of the category that you didn't understand that time because I mentioned that we'll be covering this in Chapter 9. So gains and losses is part of that other section. Meaning that those are minor expenses, minor revenues that may not necessarily happen in each and every season. Because if we do not sell or trade plan asset, we don't have this category. So this only exists whenever an asset we're trying to either throw it away, dispose it, or sell it or trade it with other type of assets. Then we will consider any gains and losses for plan assets. Okay, so this category here, gains and losses on plan asset, falls under the third section of multi-step income statement. So if a company has this category, then after operating income, you would consider, you would add gains or minus losses, then you get to net income. Okay, so it's reported also in income statement. It's a type of revenue and expense, just it's related to plant assets. Okay, now if we want to categorize plant assets, it typically breaks down to 3 categories. I was trying to write this on the whiteboard earlier. The 3 categories of plant assets, you can differentiate it by its physical appearance of the asset, tangible assets, whether it's the natural resources that comes from the ground directly. We don't do any human manufacturing or processing step to it. These are natural resources. Intangible assets is another type. Intangible assets basically link to anything that has creativity, ideas, or intellectual property related. Okay, so if you look at the detailed categories here, patents, copyrights, software programs, these are all the things that have a design aspect, design factor in it. So meaning that if you look at the software program, if it's captured in a DVD or a CD, let's say, the value doesn't come from the disk or the case itself. It comes from the idea, the intellectual property in it that's being captured in the DVD or in the disk. Okay, copyrights, patents, if you write a book, the things of course doesn't come from the book itself, it comes from the idea in it. So intellectual properties goes into the intangible assets part. You can't really see the value of the asset by looking at the appearance. Okay, it's the idea in it. So as opposed to this, tangible assets are the things that you can pretty much identify its usefulness by looking at it. Right? Furniture, up to now, all the things that we talked about as plant assets pretty much falls under this category. Okay, so if you take a look here, you see land, furniture, equipment, desk, building. These, of course, are not the exhaustive list of all the tangible assets, but these are the key points, the main ones that you will see in this chapter. Okay, now natural resources, these are the things that has never been manufactured or processed by human. So some of the companies may be dealing with different types of minerals, different types of resources that are extracted from the ground. So we'll be counting the value by barrels of these resources, tons of these resources, typically by its weight. Okay, later on next Monday I'll talk about this, unless we have time today. So these different types of plant assets, we have different ways to determine how we have been using these assets. Depreciation only links to tangible assets. Okay, so keep in mind that the 3 different methods that I will be covering today all links to the way to account for tangible assets. So the main focus of this chapter, I would like you to know how to use those 3 depreciation methods, and all of them relates to how to depreciate tangible assets, the ones that you can actually physically see by your eye. Okay, any types of machine, equipment that you see in the warehouse is considered tangible assets. Okay, furniture, cabins that you see in administrative offices, tangible assets. Okay, these 2, not each and every company has them on their balance sheet. Okay, only a specific type of industry has natural resources. Only a specific type of industry would have intangible assets. But pretty much each and every company would have the first category, real tangible assets. Okay, so the first category is the core here. These 2, only specific type of industries uses them, and you will see it appearing on balance sheet. Otherwise, you wouldn't see these 2 categories. Okay, now an exception here is that, remember I mentioned earlier, land is never depreciated. Okay, here's an exception. Like later on we'll talk about depreciation methods, but none of them applies to land. Okay, all the other tangible assets will be depreciated along the years based on the miles that we have been using the truck, different types of vehicles. The land is the only account that you have to keep in mind. We do not depreciate it, no matter how the problem tells you that the original purchase price, or we estimate how long it can be used in the business. We do not divide it by years, spread it along the years. Okay, because land also, the value of it constantly may be changing, so we don't estimate how long we have been using it. Okay, there are specific terms that you need to know that relates to depreciation, the concept of wear and tear of assets. So this term here is only used for tangible assets. We would say we depreciate land, depreciate building, depreciate equipment, machinery, different types of furniture. When it comes to natural resources, the term we use is depletion. Okay, the concept here really is very similar. It's just that we categorize assets into different categories, and we use specific verb or noun to estimate and to measure different types of assets. So meaning that whenever you see depletion expense on income statement or accumulated depletion on balance sheet, you know this links to a certain type of mineral, certain type of natural resources. But the idea really is the same as depreciation. Okay, but when you see depreciation expense, accumulated depreciation, you know it's talking about tangible assets usage. Now for those intellectual properties, the ideas, creativity, those type of intangible assets, we use the term amortization. Okay, amortization also, typically will be spreading copyrights or patents cost along the years. So whenever you see amortization expense, accumulated amortization, that links to intangible assets usage. Okay, so it's just a way to differentiate the different type of asset. The idea is the same. We're trying to estimate how we have been using the asset by estimating expenses, trying to match it against the revenue that these assets help the company generate. Question?
Going back and looking at what you said about real or assets as land, why wouldn't that fall under natural resources?
Land. Natural resources, when we talk about this, usually the definition is we actually extract a part from the ground. So later on when we talk about depletion, you'll understand why. Because depletion, we always want to measure the total weight of the natural resources that's under the ground, and then compare against how much that the company has actually extracted from it. So it'll be like barrels of oil or tons of certain minerals, right? But land is basically on the face of the ground. We cannot estimate based on how much we usually set a boundary of the land, right? And then we estimate the market price, the appraisal price for the land, but we can't really extract a part from it. Okay, just the definition of natural resources, we usually estimate it by tons, the weight of it, or basically the landscape of it. Okay, and another thing is that since we don't depreciate it, so it doesn't fall under the way we measure natural resources. Okay? Okay, any other questions before I move on to measuring the costs of different pieces? Okay, in terms of measuring the cost of plant assets, so before we go into how to depreciate the asset, we have to know what to depreciate. What is the amount to depreciate? Meaning, what was the original historical purchase price of different type of asset? Okay, so this goes back to cost principle. Remember, we talked about cost principle along with other types of, stable unit, monetary unit principle, entity concept earlier in the first 4 chapters. So the core of cost principle is that we always journalize an entry and its value based on that specific date's transaction, the agreement between the two parties. Remember, the purchase price is the historical cost, meaning that whatever we paid the very same day today, if we purchase, let's say, a constructed building already, or we're trying to construct a building and we sign a contract with others, whatever is on the contract that day will be recorded on the journal in the journal entry, and we don't go back to change that number. Okay, so cost principle determines the historical cost of the asset on the very same day that transaction happens. And that cost basically is a summary of all the costs incurred before the asset is up and running, before we can actually start using the asset. Okay, so in plain English is that before the asset is using, any cost that you actually spent on helping the asset start to produce the product or start to help the warehouse, all those costs needs to be added together, journalized in the entry. So just like the concept of inventory, remember we purchase inventory, but we may have shipping costs incurred. Remember that large inventory T account, we add purchase price with the shipping price if the agreement is FOB shipping point. And then if there's discounts, we will subtract discounts. So that also works for plant assets. If you purchase plant asset, let's say say just furniture, a desk in the administrative office, that costs you $10,000. And the shipping cost will cost you additional $1,000. So that journal entry would not just be $10,000, it will be $10,000 plus the shipping cost, $1,000. And let's say you purchase another type of equipment, you also have assemble costs. You hire people, workers, to help you assemble the machine before you actually start using it to produce the products. Then any assemble cost would also be added to that journal entry. Okay, so basically any cost that incurred before the asset can start to be used in the business will need to be summarized in that entry. This goes back to cost principle. Okay, earlier we were just focusing on the dollar amount. Now I'm introducing you how to get to that dollar amount. So earlier I just directly tell you plan asset worth $200,000. But that may be a summary dollar amount of the purchase price, of the shipping cost, of any taxes, commission, anything that helps the asset to start working before we actually start using it in the business. Those we have to summarize them in journal entry. Okay, now in terms of problems that you do in these chapters, usually the problem will directly tell you what are the costs that incurred. So the easiest thing for you to do is just to add them all together. Okay, as long as it tells you before I start using the asset, the purchase price of this equipment is such and such dollars. The taxes related, commission is so and so. All of them, you just add them together in the journal entry. Okay, any cost incurred before using the asset has to be included in capitalization of the asset. Okay, capitalization of the asset means debiting the assets account. So if you purchase an equipment, you'll be debiting equipment, crediting cash or accounts payable. The debit equipment will include a summary of all the costs that incurred. That's called capitalization of equipment. Okay, just a term we use for plan assets when we journalize, when we purchase plan assets. So if we want to further categorize tangible assets, generally speaking, it falls under either of these four categories. It could be a type of furniture that you see in the office, a type of machinery equipment in the warehouse running around to support inventories, inflow, outflow. It could be buildings. Of course, you need a location to sell the products, you need a location to set the office. And also, before doing that, you need a piece of land, of course, to construct the building. So land improvement is one category, building, machinery, equipment, furniture, fixtures. And when you go back to read the chapter this week, you'll find this area pretty exhaustive because there's a lot of different types of cost that goes into each and every category. So don't bother to memorize all of them. Okay, the key point here is to understand what is the cost of the asset. And usually the problem will tell you what is the assemble cost, what is the transportation cost. So each and every company would have a different transaction. They may not hire people to assemble the machinery. Some companies may want to hire people to assemble machines. So you don't have to memorize each and every category of the cost under these four categories of tangible assets. The key concept is to know that when a problem tells you there's so and so different types of costs incurred for a piece of asset, you need to add them together. Okay, so if it tells you purchase price, that's one thing. If it also mentioned taxes, then you add taxes. If it mentioned commission, you add commission. If it mentioned assemble costs, you also had to add them. So the key point is to know that all the other minor costs to support the asset to meet its intended usage before you actually start using it in the business, those are all considered necessary costs. So it has to be a sum of all of them. Okay, introducing all the details under these different accounts is just for the purpose of letting you know you have to add them together. Those are all considered costs of the specific asset. Okay, so the only category that we'd like you to focus on really is the first one. Why? Because I mentioned land is not depreciated. However, there's another account called land improvement. These are separate accounts. Okay, land is not depreciated, but land improvement is. So this is the only one that I would like to ask you to know the details. You have to differentiate what is considered land's cost, what is considered land's improvement. Because if you mix them up, you'll be depreciating the wrong thing. Okay, so any cost that goes into land, later on the next two slides I will talk about these, those are not depreciated. You just have to add them up. That would only appear in the first entry when a company purchases a piece of land. Land improvement, anything that basically goes on top of the land. Think of it as minor costs decorating the land, the fences, sprinkler systems, signs. Those will be depreciated along the years. Okay, so this is the only thing that I want you to keep in mind. The first category, you have to know the differences between the two. So here are some of the examples that goes into land account. Okay, keep in mind, again, all of these will not be depreciated later. But the reason why we're mentioning these here is if a problem tells you the company is purchasing a piece of land, this is the purchase price, this is the brokerage fee, survey fee, property taxes, transfer cost, you need to add them all together in that journal entry. Okay, so this is an example of the possible categories that you may see in a problem. Purchase price is easy to understand. Brokerage fee, if you hire an agent to help you locate this asset, of course you may need to pay a certain fee to that agent. Survey legal fees usually is related to understanding the boundary of the land and any prior history related to that piece of land. Okay, so some of the transactions may tell you this. Expense also incurred. Property taxes definitely comes with purchasing land. Any transfer costs, costs of clearing, removing previously unwanted building there, may also be a necessary cost. So when you look at these categories, basically, if you can't differentiate land and land improvement, basically the question is, without paying these, is the company able to use that piece of land? If the answer to this question is no, then those are the things that goes under a land account. Okay, later I will talk about land improvement. Those are fencing, paving, lights, and signs are minor costs compared to these. These related to, oftentimes these has to also submit documents to government agencies. So these are necessary costs to use the land. They're not depreciated later on. They have to be added together when you journalize the land transaction. Show you an example here. All the categories of bullet points also is listed here exactly. So here's a case that the purchase price of that piece of land, assuming it's $50,000, and there's necessary related costs. The problem tells you that if the property taxes, you need to spend an additional $4,000. Transfer taxes $2,000. Removing the building will cost you additional $5,000. Understanding the property, the boundary, costs you $1,000. This transaction, if it asks you to journalize this purchase piece of land entry, then you will not only be journalizing that $50,000, but you have to add in all of the necessary taxes, removal building fees, basically all the fees that the problem tells you, lists there. Okay, it may not be 5 categories, it could be just 6 of them or 7 of them. Okay, but the key point here is that you have to know, under cost principle, we will add together whatever incurred on this day when we purchase this piece of land. Okay, so it will be a total of $50,000, $4,000, $2,000, $5,000, $1,000, altogether $62,000. Okay, now this example here, how is the company paying the money?
It's paying part of it on borrowed money and the other on a little bit of cash. Yeah.
Part of it by borrow money, right? Payable. We haven't talked about payable for a while. Notes payable, we'll touch on this in more details in chapter 10 and 11. Basically, this is borrowing money, and usually, again, you sign on a promissory note. So basically, it's the opposite concept of notes receivable. Notes receivable is the company borrowing money to others. Notes payable, your company is borrowing money from others. Okay, so to account for the $62,000, company is paying usually for real estate or for more expensive assets. You'll be paying a down payment first, and then the remaining parts you'll be paying it off later on little by little. And either in a mortgage form or notes payable form, you'll be paying it all together with interest later on to the party that you borrow money from. So this is just an example that could happen. You may be paying $50,000 by notes payable, meaning a payment later plus interest, and immediately $12,000 by cash. Okay, now in the chapter you'll see also capitalization of certain asset. This term here simply means purchasing plan asset. So we either say purchasing plan asset land or capitalization of land, $62,000. So that just means acquisition of plan asset. That's what capitalization means. So it tells you this entry capitalized land at $62,000, meaning an asset account was debited. We purchase an asset. So these are the categories under land account. And then as I mentioned, these are the necessary costs before the land can actually be used by the company. Other costs that are considered not as necessary, considered improving the land usage, meaning that without these, the company still has the legal, they're able to actually legally use the piece of land to construct buildings and do their business. But these are other things that goes on top of the land. Okay, so this we have a separate category called land improvements. Some fencing, paving, any lighting signs, sprinkler systems, any possible improvement categories that goes into this account, this categorization, that we just separate them from land. So altogether, these costs would actually be spread along the years of its useful lifetime. We will be depreciating these costs later on. So as opposed to land, we have a separate account called land improvement to hold all these minor expenses on land. Again, these are not necessary costs. The company may want to spend these to improve how they use this piece of land, but it doesn't relate to submitting any documents to any governmental agencies to be approved to use that piece of land. So these are additional costs incurred. Okay, so we add them all together, assuming that all these costs adds up to $20,000, then this will be another journal entry to make. We'll be debiting land improvements, assuming we're paying by cash. If the problem says so, then we'll be crediting cash. If it's notes payable, then we'll be crediting notes payable. Okay, any questions so far? I know this is a lot of details in the account, but it's very important to separate these two. Okay, so this is the only one that I would like you to really understand the specific subcategories that goes into them in order to differentiate the two. So if you see a problem, you know what goes into land, what goes into land improvement, and this will be depreciated later, land will not be. Okay, the following few slides, I'm going to go over building, machinery, fixtures pretty quickly, because the idea is actually very similar to purchasing inventory and accounting for inventory discounts, inventory shipping costs altogether. The key concept is that if a problem tells you when we construct a building, these are the costs that incurred if we self-constructed it, or if the company actually just purchased a building that is readily constructed and you're just purchasing it from another company. Any costs that the problem tells you incurred for setting up the asset before starting using the asset, you just have to add them up. Okay, when you journalize the entry of building, debit building, you'll be adding up all the bullet points of these things that you see in the problem. Okay, again, it could only be a few of them. It may not necessarily be all of these costs. Okay, so you don't have to memorize them. Basically, any problem tells you the necessary costs incurred for building, just add them up and debit it in a journal entry building. since we're on this slide, and might as well just mention, here you see materials, labor, overhead. Now in the following class, after you take this Introduction to Managerial Accounting, there will be a whole lot of issues on materials, labor, and overhead costs. Basically, if a company is, we have only been talking about service type of business and merchandisers operations. In managerial accounting, it will touch on if companies is actually producing their own products. Then they will have to purchase certain type of materials. You have to hire workers to help you assemble the products, help you actually manufacture the products. There's other indirect costs that would incur. Managerial accounting will be taking care of how to journalize entries on materials, labor cost, overhead. There's a significant portion there. Okay, just want to mention it. Just like constructing a building themselves, you will have these costs. Constructing and actually manufacturing other types of products also needs to consider all these costs in journal entries. Okay, now for machinery, equipment here, these are also some of the examples of the costs that may incur. We definitely have the first bullet point here, purchase price of a certain type of machine, certain type of equipment. And if there's any discounts given from the seller, just like inventory costs, we will reduce discount. We will also reduce any discount, meaning that we'll be paying less to the party who sold us the machine or equipment. Transportation charges, just like inventory, if we agree on FOB shipping point, purchaser will be the party paying the transportation costs. So this will be the cost that adds to machine and equipment. Okay, so a lot of these really is very similar to Chapter 5 when we talked about inventory. Any installation costs, any assemble cost that helps the machine to, before it starts being used in the business to start produce products or start moving around inventory, any cost incurred before asset can actually be used in the business will need to be summed up together. Okay, now this note here, you have to keep in mind also, up to now we have been talking about all the capitalization of assets, meaning all the cost of the asset to help it start being used in the business. If after the asset has been using in the business for some time already, it has been starting to manufacture the products, move around the products in the warehouse, after that point, if there's any repairs, maintenance, and really it's just a routine repairs, for example, like oil change, battery change, all those things will be considered expenses. Okay, capitalization is under asset account, just like these journal entries that we make is under, this is an asset account, right? But after we purchase a machinery equipment, if it needs to be fixed and it's a minor fix, it's just like battery change, oil change, those things that helps to sustain the machine and equipment to continue to be used in the business. All of those are considered expenses, repair and maintenance expenses. So meaning that machine equipment historical cost goes into balance sheet, expenses will go into income statement. Okay, so now consider part of the cost of the asset anymore because it doesn't really gain the asset's lifetime. So an exception to this would be if a machine broke down in the middle of an operation cycle, and let's say we do a major repair on a certain portion of the asset. And after that major repair, accountants estimate that this asset could be extended its useful lifetime for 5 years, then that's a different case. Okay, if the lifetime of the asset could be extended for more than a year, then it's not considered expenses. It will be adding to the capital costs of the asset. Okay, so there's basically two cases I'll mention this in more detail next Monday. You either be capitalizing the asset or expensing the asset. So earlier, if you purchase an equipment, let's say that worth $10,000, and this $10,000 includes the purchase price, transfer cost, any cost for installing the asset, this will be the original price that you debit for equipment, let's say. And let's say we pay by cash, credit cash. This is before the asset is being used. After it's being used, we need to determine whether any repair and maintenance is major or minor. So if it's a routine change, battery change, oil change, that's minor, goes into expenses. Meaning later on, once the asset has been used, and and after a year or a season, we spend $100 on changing the oil of a certain asset, then that's considered repair maintenance expense, and we credit cash. Okay, so earlier this is an asset entry, this is an expense entry. This is for minor repairs. Now in cases that it's a major repair, if anything, part of the equipment machine broke down, and we do a significant change for the machine, we either replace the entire engine or something like that, that actually extends the lifetime of the asset. So in that cases, any major repair, we don't consider them as expense. Expense is for a shorter time frame. Okay, any major repair, we capitalize them. So if a major repair extends the asset's lifetime for more than a year and we actually spent, let's say, $5,000 on it, then this $5,000 will go into equipment, not expenses. So the lifetime of the asset has been extended and the cost of the asset will be added. Okay, I just want to mention this since we're on this slide. After the asset is up and running, any minor expenses, repairments goes into expenses. Before it's running, all these major costs is considered part of the asset account itself when we purchase it. Now another case is after the asset is up and running, any major repair, changing the entire engine, a major part of the equipment that extends the lifetime of the asset for an additional year or two. As long as it's more than a year, it goes into asset account again. So overall, your T account for equipment later on will be of the original $10,000 plus that major repair, $5,000. Okay, so this is the difference of capitalization and expenses. So if anything is minor, we consider expenses. Anything that's major is part of capitalization of the asset, part of the asset's value itself. Okay, now for furniture fixtures, the same deal. Purchase price, shipping cost, cost to assemble, all of them, we add them together before the asset is being used. Any minor repair after that goes into expenses. Any money that you spend on major repair extends the lifetime, goes into asset account. I'm going to go into depreciation now. So depreciation, we want to measure how we have been using the asset, the wear and tear of long-term assets, and specifically tangible assets. So here we want to allocate plant assets cost based on its useful life and based on how we have been using the asset. So there are three main methods of depreciation. We have readily talked about straight line earlier in the first 4 chapters. Straight line, basically, we just spread it along the years. We have an equal depreciation and expense every single season. So there's no difference if you compare across the years. Other types we may be based on, for example, how many miles has been used in a vehicle, okay, or how many miles have been used in other types of, let's say, plane. Different types of transportation plant assets, or how many hours the machine has been used. So that's another type of depreciation method called units of production. So basically that idea is that the more we use, the more we'll be depreciating the asset. Okay. So the idea of depreciation here, just a reminder here, I mentioned this briefly in the first 4 chapters. This is measurement. It's an estimation of how we use assets. It's not a type of, it doesn't involve cash at all because this is just an estimation of depreciation, how we use long-term assets. We're not really trading it yet. Okay, so once you purchase in an equipment, let's say $10,000, if you estimate the lifetime is 5 years, then you divide it by 5. And then every single year you depreciate the asset by that value. Okay, now here's another example. Let's say we use straight line depreciation for the truck. Originally we purchased it at $40,000. This is the price that we paid out to the seller. And let's say the estimated useful lifetime is 5 years. Then every single year we'll be depreciating $8,000, consider it as depreciation expense, and at the same time credit accumulated depreciation. Okay, so remember the depreciation entry, debit depreciation expense, credit accumulated depreciation. So what is this account here? Which financial statement does it fall under, accumulated depreciation? Anybody remember which financial statement does it fall under?
Asset.
Asset, and specifically, well, asset is the category, and asset falls under balance sheet, right? So you have balance sheet, left side asset. You have, first of all, whatever the planned asset is, equipment, machinery, and then you have a contra asset account, accumulated depreciation, right? Remember, contra asset is the opposite direction of regular asset account. So this accumulated depreciation has a normal balance under the right side. It's a contra asset account. It goes under whatever the original asset was. It could be equipment, it could be machinery, any of the 4 categories besides land. So you have the original purchase price. This example here is $40,000. After a year of using this asset, you will find $8,000 listed under accumulated depreciation, right? Because this is an account that measures how we have been using the asset. The wear and tear of the asset we estimate is $8,000. So that transaction will happen every single year for 5 years. So this readily is an example of straight line depreciation, spreading the cost along just the useful years. Okay, so what happens to this $8,000 is it goes under contra asset account. It also goes under depreciation expense account. Because remember, each and every entry affects these 2 accounts. So if it's a type of expense, later on it will be subtracted from revenue. Right? So just like other expenses. So this idea of depreciation, really we're trying to match up how we have been using planned asset and consider it as a way to support revenues generation as well. So expenses, all the other types, sales, general expenses, administrative expenses, just like those, we also estimate depreciation expenses and match it up against revenue. So this is the whole purpose of doing this, measuring that we have been using long-term asset. Right, so how do we do this in details? From this point on, when we do depreciation calculation, you have to pay attention to what is the asset's cost. Just like earlier when we mentioned the asset cost includes transportation costs, the purchase price, you add them together. Then you subtract any residual value that goes into depreciable costs. Okay, what this means is residual value is the leftover value of the asset. When an asset is purchased into the business, we usually estimated the useful lifetime, which is the golden years for the asset, the years that the asset will perform most efficiently and effectively. So earlier that example was using the asset for 5 years. That doesn't mean that after 5 years the asset will not be running at all. That just means that 5 years is the major years that the asset could be used most efficiently. So usually when it reaches the point of 5th year, the company would decide to either reevaluate that asset, either continue to use it, or throw it away, or trade it in for other asset. Okay, so the residual value is the expected cash value after you use it to the very last year. If you sell it to other markets, the second-hand market, what is the cash value that you can get back for that asset? Okay, so it's the leftover value for each and every asset. Now the cost of the asset, I just mentioned this earlier, the purchase price mainly, and then other transportation costs added together. But typically most of the problem will directly tell you what is the original purchase cost. And then it will tell you what is the leftover value, and you just use the net of these, and then you spread it along the years for straight line method. Okay, so depreciable cost is really the part that we will be depreciating later on. Residual value we excluded because that's the part when we reach the 5th year. That's the value that we expect to get from when we trade it or when we sell it. So we don't depreciate that leftover value. So meaning that if an asset worth $40,000, the purchase price, and let's say the estimated residual value is $1,000, then we only depreciate $39,000. This is the depreciable cost. And we spread this along, let's say, 10 years, then we divide it by 10. If it's 5 years, we divide it by 5. Okay, so we only depreciate this part here along the years. We don't depreciate the leftover value, because this is the value that later we estimate we'll be getting when we sell it or trade it. Another way to say residual value is the salvage value. These are interchangeable terms. Basically, again, the leftover value that you can get. Okay, I'm going to skip this for now. We're going to go into these three methods. Basically, this is evenly spreading along depreciable cost every single year the same. This we based on how many miles we have been using for the vehicle, how many hours it's been used for the machine. Double declining is a special method. We only usually use it for high-tech related products, so like computer or different types like iPads, iPods. Technology-based assets, we estimate that early on the years it will be highly depreciated compared to later years, because usually those are the assets that grows obsolete very quickly. Okay, so double declining balance method, we don't spread along depreciable costs evenly. We assume that the earlier the years of the assets, it usually depreciates faster than later years. Okay, I'll go back to the concept again as I go into each and every method. So, for all three methods here, all links to this depreciation entry. So this is really not news to you, because we already talked about this in the first 4 chapters. The key point here is that we want to determine what goes into the dollar amount. What is the part that we want to depreciate? So always, for all three methods, when we depreciate, it will always be this entry. But companies can decide which method to use for which type of asset. They have the discretion to do so. Okay, so you need to know all three methods, how it works. Straight line depreciation is the simplest one. It's also the one that we have been talking about all along. So assuming in this example, the cost of the truck when we purchase it in, plus all the transportation costs, worth $41,000. And let's say it has a leftover value of $1,000, meaning when later on, after using it for 5 years, when we sell it, we can gain $1,000 back. So that's the dollar amount that we don't want to depreciate. That's not part of depreciable cost. We subtract it. Okay, so the right-hand side here, you have $41,000 the purchase price minus any leftover value. This is the part that we want to spread along the years, $40,000 only, divided by 5 years. This part here only factors in if the company wants to do a monthly statement. Or let's say the company purchased the asset later on the year, not from the beginning of the year. Then you determine what is the monthly depreciation. Otherwise, if the problem asks you yearly, you don't have to do anything about this. This is just like how we calculate interest, remember? So this is like if the problem is asking you half a year of depreciation, then you times 6 months over 12. If it's asking you to do a monthly statement, monthly depreciation, 1 over 12. So this only plays a role if the problem is asking you a question other than yearly depreciation. So in this case here, every single year we'll be depreciating $8,000 for this truck. This happens December 31st for this year. This also happens December 31st for next year, for the following year, for 5 years. If we take a look at a table of all the years of depreciation, it will look like this. This is exactly the same concept, just spreading along and also listing the equation here. Okay, don't get thrown off by all these numbers. Really, it's very simple. Left side, just the original purchase cost. Right side here, you have the book value, which matches with it the first year. But later, when we use the asset, the book value will gradually decrease. Remember that book value, the definition is cost minus accumulated depreciation. This really is the current usefulness of the asset. Okay, as we depreciate the asset, the book value will gradually decrease by $8,000. So the middle part is just how we got to this $8,000, and then every single year we do the same thing for straight line method. Okay, so this will continue for 2 more years, and then it will reach the residual value of $1,000 at the end. Then the company stops, they reevaluate the asset, they may decide to sell it, and oftentimes, very likely, they will be getting a dollar amount close to $1,000. Okay, any questions so far? No. Okay, let me go into the second method here since we have a problem for homework, running a little late on time. Units of production method here is the second type of method. Usually it's used for machines, for vehicles. Anything that you can find a unit to based on. So earlier, straight line method is typically used for the furniture, cabins, desks. It's pretty hard to tie how you have been using that with the revenue that you gained, so we just spread it evenly along the years. For units of production, if the type of machinery, vehicles, you can actually estimate how you have been using it by tracking the miles that has been driven, by tracking the number of hours the machine has been working on a daily basis. And oftentimes, units of production method would suit those type of assets depreciation best. So how does this method work? If we use the same example here, assuming the truck costs $41,000, residual value is $1,000, leftover value is the same number. We expect that this truck, in total, they can be used for 100,000 miles. It can be driven by 100,000 miles. Okay, so in this case here, we want to find a unit depreciable cost for each mile. So each and every problem will tell you what is the total capacity of that machine or total capacity of a certain vehicle. What you need to do is, again, find the depreciable cost divided by the total capacity, figure out a unit depreciable cost first, and then just use this unit cost times whatever miles has been used in this season, or whatever machine hours has been used in this season. So this part will stay the same as long as you calculate it once. Okay, again, the depreciable cost, and then divided by the total capacity. So this could be the total number of machine hours that the equipment can be used, the total miles the vehicle can be used. Then you figure out per mile what's the depreciable cost, or per hour what's the depreciable cost. And then use the cost times the number of hours that has been used in this year, or the number of the miles that has been used for a certain vehicle. That will be the depreciable expense, the depreciation expense for that season. Okay, if we look at the table here, this is how it works. Again, left side is the asset cost, right side is the book value. Middle part here you see depreciation per unit. Earlier we calculated as 24, right? So if the first year we use 20,000 machine hours, or the vehicle has been driven for 20,000 miles, then we use that unit times 20,000. Next year, assuming it's 30,000, then you times 30,000. So this middle part here depends on the problem. So it could be changing. If the problem tells you it's 10,000, use 10,000. Calculate the depreciation expense for each and every year. So this depreciation expense is no longer even across the years. It depends on how the vehicle, the machine has been used. If you use it more, like this case, compared to the first year, you depreciate more. If you use it less, like this year compared to the first year, then you depreciate less. So you basically assume the more we use an asset, the more wear and tear, the more depreciation will be listed. Now, at the end, you see the residual value here, 1,000. This basically tells you that at the end, after depreciation, we still have this leftover value because earlier, when we calculated the 0.4, we subtracted it up front. Okay, now journal entry is the same. Whenever you get this each and every year's depreciation, you'll be debiting depreciation expense, crediting accumulated depreciation. So the first year will be 8,000, second year will be 12,000, third year 10,000, 6,000. Fast forward to the third method. I wanted to get to it very quick. I'll come back to some examples with you next Monday, because there's a homework question on this, and I'm afraid some of you have started working on it. You can't change the numbers. So double declining balance method here is the one that I mentioned earlier. Early years, we estimate there more depreciation being listed. So this is how we calculate the depreciation for double declining depreciation method. We start from the historical cost of the asset again, but here we don't minus residual value, okay? We minus accumulated depreciation in total times 2 over life. So that 2 there basically is why we call it double declining. If you look at an example here, it's very close to straight line because we're spreading it along the years, but we're spreading it along the years and then times it by 2. So meaning that if earlier double straight line gives you 8,000 depreciation, this one will give you 16,000 depreciation in early years. Okay, so double declining we fit in that example earlier, we have 41,000 here, minus 0 for the first year, times 2 over 5. That will be the first year's depreciation. Now residual value is not in the formula, we just ignore it until the very last year. Okay, I'll tell you why. So basically this bracket here is book value. For double declining method, we always use book value times 2 over the useful lifetime. So if it's book value, every single year the book value will be changing. You will gradually have a lower book value as we depreciate the asset, which is why later years depreciation expense is less than early years. The first year, you definitely have the highest level of book value. Okay? So the table here is that you have depreciable costs on the left side again, book value on the right. This middle part here, you see 2 over 5. That's why it's called double declining. So the first year, you depreciate 16,400. And then the following year, you use the up-to-date book value to times 2 over 5. So you see the book value is constantly changing. When it reaches the very last year, close to the second to the last year, you just depreciate any differences here, 4,314.